So a warm good evening, everyone. I, Ryan DeCijos, student of St. Berkman's College, take this opportunity to warmly welcome you all to the ninth annual memorial lecture in honor of late Professor C.O. Abraham. First of all, hearty welcome, everyone. So before we begin, let's see a small introduction about Professor C.O. Abraham and the previous speakers of this lecture series. So Professor C. Abraham, he was the distinguished alumni of St. Berkman's College. He was an outstanding teacher, a passionate professor, and a socially active person who showed a keen interest in public life. And the key notable series of the speakers of this series are Professor Prabhat Padnik. He was the Vice Chairman of Kerala State Planning Board from June 2006 to May 2011. And Professor Pulin B. Naik, Professor M. Govinda Rao, Professor Vamsi Vagulbharanam, Professor L. Venkatachalam, Professor N. Nagaraj, Professor Legha Chakrabarti, Professor C. Balagopal. He was the former chairman of Board of Federal Bank Limited. So, formally, let's begin our session. To begin with, first I invite Dr. Shinuvarki, Head of Department of Economics,
Hi,
for the
teacher.
welcome address.
Good evening, everyone. Honorable dignitaries of the day, Reverend Father Rajiv Kurian, Principal, St. Berkman's College, Professor Madhura Swaminathan, Head of the Economic Analysis Unit of the Indian Statistical Institute, Bengaluru, Dr. Rajan Varghese, Member Secretary, Kerala State Higher Education Council, dear teachers and my dear students. The Department of Economics at St. Berkman's College is pleased to pay tribute to its esteemed teachers who have greatly contributed to the advancement of economic studies in Kerala. This evening, we have gathered here to warmly remember and celebrate the invaluable contribution of one such devoted and gifted teacher, Professor C.O. Abraham. Our homage to him is manifested in this annual memorial lecture. Professor C.O. Abraham was a highly dedicated and devoted teacher of our department, and he commanded immense respect from his peers, colleagues, friends, and students. His profound grasp of economics, notably macroeconomic theory and classical political economy, was truly remarkable. Moreover, he exemplified exceptional human qualities, radiating love, affection, and warmth. He passed away on 9th July 2013. This annual lecture series, in loving memory of Professor C.O. Abraham, is the outcome of the memorial gathering organized by the department after his demise. We consider that meeting, which was attended in large numbers by his students, as a watershed moment in the recent history of the department, which energized us in great deal to organize various academic events with real content, providing exposure to our student community. As already mentioned here, the first lecture in this series was delivered by Professor Prabhat Patnaik in 2015. And other distinguished speakers of the lecture series were mentioned here. And this is the ninth lecture in the series. First and foremost, I cordially welcome our dear principal, Reverend Father Rajiv P. Kurian, who is the president of this gathering. I'm glad to say here that he is a constant source of inspiration for all the initiatives of our department. Hearty welcome, dear Father. For this year's lecture, we have among us a prominent academic, Professor Madhura Swaminathan, who is currently head of the Economic Analysis Unit at the Indian Statistical Institute, Bengaluru. She holds expertise in development economics, agricultural economics, food security, gender, and labor economics. In her extensive research, she has focused on poverty, inequality, human development, rural credit, microfinance, women's roles, child labor, and education. Professor Swaminathan has contributed significantly to the academic field through numerous publications, including books, monographs, journal articles, and contributions to edited volumes of nationally and internationally reputed publishing houses. Her dedication to understanding and addressing socio-economic issues in India is evident in her works on gender disparities, rural development, and the public distribution system. Through her research and teaching at the Indian Statistical Institute, Professor Swaminathan continues to make significant contributions to the field of development economics. Above all, she is the daughter of Bharat Ratna M.S. Swaminathan, who is acclaimed to be the father of Green Revolution in India. Dear ma'am, with a lot of affection and happiness, I welcome you to the Professor C.O. Abraham Memorial Lecture 2023-24. To share with us the fond memories of Professor C.O. Abraham, we have among us Dr. Rajan Varghese, who is a proud alumni of the MA Economics 1980-82 batch. He is currently serving as the Member Secretary, Kerala State Higher Education Council. With immense joy, I welcome you, dear Rajan Varghese, sir, to this August gathering. Hearty welcome to all our former teachers of the department, whose efforts have been pivotal in shaping and enhancing the department to its current stature. I gratefully acknowledge the efforts of our teachers and students in the department to gather together all the arrangements for the lecture today. Very specially, I remember the efforts of Professor Johnson K. Joyce, the coordinator of the program today. Hearty welcome, dear sir, and all my colleagues and dear students of the department to this gathering. Finally, I welcome all the other participants of the lecture, teachers and students from other departments of the college and institutions around the college, and our dear alumni of the college. Once again, welcoming you all, I remain. Wishing you all a very highly engaging session ahead. Thank you very much.
Thank you, sir. We are graced by the presence of a principal, Reverend Father Reggie P. Kurian. With much honor, I invite him for the presidential address.
Thank you, Raina. Dear respected Dr. Shinu Waki, the head of the department, economics, Dr. Rajan Wagi sir, our proud alumnus and member secretary, Kerala State Higher Education Council, who is remembering the great professor, Professor C.O. Abraham, Professor Madhura Swaminathan, the resource person, and Professor and Head, Economic Analysis Unit, Indian Statistical Institute, Bangalore. Respected teachers, both retired and who are in service, distinguished alumni members of the Department of Economics, family members of Professor C.O. Abraham, invited members, and my dear participants. Good evening to all. St. Berkman's College, having a tradition of 102 years, is always made great by its notable alumni and by its great teachers. And on remembering Professor C.O. Abraham, an outstanding teacher who inspired the students with his range and depth of knowledge, Dr. Rajan Wagi sir will be remembering his contributions, and I don't go into details. But SB College gratefully remembers his contributions to St. Berkman's College and think that it is fitting to remember this great academician through the memorial lectures by internationally renowned scholars, which was started with Prabhat Patnaik in 2015. And I am happy to welcome once again Professor Madhura Swaminathan, daughter of our own M.S. Swaminathan, because we are very close to Kutanat. That is why. You are from Mangam,
Yes.
Yes. That's why. Dr. of our own Dr. M. Swaminathan. We are proud to have you for this academic exercise or session. Mahatma Gandhi always pointed out that the soul of India is in village or in villages. Our economy is mostly dependent on rural and agricultural products. While rural communities need financial services the most of the time they remain the largest unserved market for financial services. Ensuring their financial inclusion can unlock the considerable economic potential of rural areas and benefit the rural poor by increasing household income and decent work. And I am sure that this session will give you all a clear perspective in this area for the future India, which is marching to become one of the largest economies in the world. I wish all of you to have a fruitful session, and this will be a great tribute to our Professor C.O. Abraham, a great economist. Thank you all. I remain once again. Thank you all.
Thank you, Father. Professor C.O. Abraham was a distinguished alumni of St. Bergman's College. He was an outstanding teacher, a passionate professor, an amiable and socially active person who showed a keen interest in public life. To share fond memories of Professor C.O. Abraham, we have with us our distinguished alumni, Dr. Rajan Varghese, Member Secretary, Kerala State Higher Education Council. So with much respect, on behalf of Department of Economics, St. Bergman's College, I invite Dr. Rajan Varghese for the same.
Respected Principal, Reverend Father Reggie P. Kurian, Professor Madhura Swaminathan, the Indian Statistical Institute, Professor Shinu Varki, Professor Johnson K. Joyce, respected teachers, and my dear students and friends. I am very privileged to attend this meeting. It's Professor C.O. Abraham's Memorial Lecture organized by the Department of Economics of SB College, and also to speak a few words in memory of my beloved teacher, C.O. Abraham sir. I was a student of the college way back in 1980. So our period was 1980-82. So nearly 4 decades ago that I experienced the warmth and affection of my teachers and of my college. The impact that teachers have on their students' lives is immeasurable. The best teachers not only impart knowledge, but also inspire and motivate students to achieve their full potential. In my experience as a student of economics, I was fortunate to have had the opportunity to learn from exceptional teachers of SB College who transformed my life. I enrolled in the PG program in economics in SB College, as I said earlier, way back in 1980, with a vague idea of what I want to do with my life. I had chosen economics because I had a very good standing for my BA program. But beyond that, I had no clear goals. It was not until I met my great teachers in SB College, especially my teachers in the Department of Economics. So, I was able to realize some of the goals of my life. Professor C.O. Abraham was also my warden in the Moore House, where we enjoyed the maximum freedom. Actually, the college brought this Moore House to accommodate one of the most illustrious professors at the college, Professor C.S. Shepherd. So later it was given to the students, and Professor C.O. Abraham sir was the warden in that hostel, and we enjoyed maximum autonomy in that hostel. C.O. Abraham sir was not just a teacher. He was a mentor, a friend, and a guide who helped all of us to navigate the challenges in the field of higher education and their career. His dedication to teaching and his students was exemplary. His passion for teaching was contagious, and his enthusiasm for the subject matter was tangible in every class. He introduced to us the works of several modern economists, which actually laid the theoretical foundations of our study in economics in general and macroeconomics in particular. Even during 1980s, he explained the contributions of various schools of thought. In economics, I still remember those classes. So different schools and their distinguishing features. His classes on classical school, the neoclassical, Keynesian, and the post-Keynesian schools, and the theoretical contributions of these various schools actually impressed us. Actually, we were at that time exposed to a new world. Say it provided new perspectives to our learning process. And his passion for discussing the Keynesian and the post-Keynesian theories in detail, it was evident in every class he handled. The theories of distribution propounded by Nicholas Calder and Michael Kaleski, referring to the degree of monopoly theory and the coefficient of sensitivity of capitalist growth, the famous Calder's dictum that capitalists earn what they spend and workers spend what they earn are still fresh in my memory. The high level of inflation witnessed in the Western countries during the 1980s was a major topic of discussion all over the world. This was also reflected in our classroom by the lectures of Professor C.O. Abraham. He explained in detail the phenomenon of jobless growth and the Phillips curve. He introduced modern theories and trends even at that time. The contributions of Milton Friedman and the Chicago School were also a major topic of discussion, in which he explained the theory related to the demand for money in particular. I was greatly impressed by those topics. He faithfully followed a book which we used to borrow, titled Macroeconomics and Fiscal Policy by Westway and Wyman Jones, for explaining in the modern mathematical version of Keynesian and post-Keynesian models of growth or equilibrium. The ease with which he explained those mathematical equations for explaining the theory was very impressive, though it was very difficult for some of us to follow. Even way back in 1980s, he explained the application of mathematical tools and econometric methods. He also explained the use of large-scale data, which is now used in a big way in today. He explained those ideas in 1980s for forecasting economic growth in the long run, because he was greatly impressed by the economic growth of the planned economies. And his book on economic system was most impressive, and it was widely circulated among the teachers and students. He also introduced modern ideas related to the Laffer curve, which began to influence policy making in Western countries. He also discussed at the time various controversies related to equilibrium analysis propounded by noted French economist Gerald Debreu. It was also a period during which India resorted to massive external borrowing from World Bank. I'll still remember the discussion and debates organized during this period by the department, in which teachers participated in a big way. And we titled the discussion debate as IMF borrowing a lifeline or a debt trap, which actually created a huge debate at the state and the national level. So our college was in the forefront of championing all those trends even at that time. It was during this period several prominent teachers from several universities in India and abroad visited our college. I'll still remember the interaction that we had with, say, leading faculty from the University of Kerala. These teachers included Professor Gopinathan Nair and Professor Ramachandran Nair of the University of Kerala. In fact, the scholarship displayed by Professor C. Abraham had elevated the Department of Economics of SB College to the stature of a university department and a major seat of learning in this part of the country. His sterling contributions in teaching and learning in economics will be remembered by his students and the department for years to come. I pay my homage to all my beloved teachers who are no more with us today, and especially to Professor C.O. Abraham during this time. I also thank the principal and members of the faculty of the department for giving me this opportunity to make a reference to our beloved teacher. With these words, I conclude. I thank all the teachers, students, and also I greet Professor Madhura Swaminathan on behalf of the State Higher Education Council. Thank you very much.
Thank you.
Thank you, sir. Thank you, sir, for sharing such beautiful memories with C.O. Abraham, sir, and telling us how he navigated students to excel in their career. Thank you, sir. Thank you so much. Then today we are much honored to have with us a very notable person, Professor Madhura Swaminathan, daughter of legendary agricultural scientist, late Bharat Ratna M.S. Swaminathan. She is a professor at Economic Analysis Unit, Indian Statistical Institute, Bangalore. She has a doctorate in economics from University of Oxford. She was a member of Government of India's high-level panel on long-term food security. With much honor, on behalf of Department of Economics, St. Bartholomew's College, I invite Mrs. Madhura Swaminathan to deliver the lecture on topic Rural Credit and Financial Inclusion.
Thank you, Rini. Reverend Father Kurian, Dr. Varghese, Dr. Shinu Varki, all the faculty, retired and present, and students. I'm very happy to be with you here today, though online. As Reverend Father said, Alapura to Changanacheri, that road is a very famous road and which is a beautiful one. I think one of the most beautiful landscapes in India, if you ask me. So I hope to visit in person too at some stage. I did not know Professor Abraham, but what I have read about him and what we have just heard, he was not only a committed teacher, but very knowledgeable and particularly interested, I believe, in macro and monetary economics. So I hope this discussion today, which is linked in some way to banking, which starts at a macro level, but has very micro implications, I'd like to talk about it. So I guess you are sharing the screen, is that right? Should I move the screen or will you be doing it?
I think Mary is sharing the screen. Yeah, Mary, you can move the screen from your end. Yeah.
So what I'm going to talk about today is a policy which is now the official policy of the Reserve Bank of India, called financial inclusion. And by the very nature of the term inclusion, we can see that the objective has been to reach financial resources, financial services, not just credit, but deposit, insurance, saving services to those who are marginalized. And my focus is on rural India. I have largely spent most of my life studying the rural economy, so I will talk about rural, but there are, of course, marginalized households in urban areas. So the poorest households, the manual worker households, wage worker households, scheduled caste and scheduled tribe households, women, are all these sections of rural society getting access to credit. That is really the focus of my research for the last few years. In fact, I worked on rural credit even for my doctoral work, and I've come back to it now. Next. So for some of you, next slide, please. Some of you who are maybe not so familiar with the rural areas of India, from the time of independence, the problem of rural credit has been something that has concerned governments and Reserve Bank of India. And that is because we find that rural households, the peasant is heavily in debt, but the credit they get is from money lenders. So the credit market in economic terms is very imperfect and fragmented. Access to credit is unequal across regions, across class, across gender. And the poor, the indebted peasantry are heavily exploited by the kind of loans they take. In fact, there's a very famous saying, quote from Malcolm Darling, who wrote about Punjab during the colonial period, that the Indian peasant is born in debt, lives in debt, and dies in debt. So the poor, the peasantry, other sections of rural society have need for credit for day-to-day consumption, for housing, education, health, productive enterprises. And what is access to credit that they have? Now, before going further, I want to make one distinction very clear, because that I'll keep using these terms. In the discussion on credit, we have a divide between what we call formal or regulated sources of credit and informal sources of credit. And the issues that I talked about, like imperfect, very high rate of interest, loans given on oral contract, these are all in the informal sector. So one of the objectives of banking policy right from the time of independence has been how to expand the reach of the formal sector, of what we are the banks, well, largely the banks and the cooperatives. We have new components, and I'll be talking about that later. Next slide. So in major, I think, shift, the first important shift in post-independence banking policy was in 1969. We can go to the next slide, where Mrs. Indira Gandhi actually nationalized 14 scheduled commercial banks, our public sector banks of today, like Bank of India and so on. And this led to this was part of a major shift in policy, which has been called social and development banking. Now, as this term indicates, the objective of this is that the banking policy should be used for development purpose. And various measures were introduced. I can't go into all of them, but I'm giving you some examples to ensure that the banks reach out to rural areas, that the banks reach out to marginalized sections of our society. For example, there was branch licensing policy. For every branch opened in the metropolitan area or city, banks had to open 4 branches in unbanked rural areas. Next slide. The concept of priority sector lending was introduced. So again, as the term indicates, these were the areas that were given emphasis by the Reserve Bank: agriculture, small-scale industry, small transport operators. These are the priority sector. 1/3 of priority sector loans had to go to, this is an error in the table, weaker sections. 18% was the target set for agriculture within the priority sector. So in this way, the public sector banks, now nationalized banks, are being asked to what we call directed credit. That is, to ensure that there is lending towards sections of society, towards agriculture, towards the peasantry who did not have adequate access to the formal credit. So as I said, the starting point is that rural households are dependent on this informal sector, which is highly exploitative. And so we need to ensure that the formal sector of credit reaches them. Another very important policy was the regulated rate of interest, scheme of differential rate of interest. So in fact, for many sections of society, the rate of interest was 4% or 5%, whereas the rate of interest for borrowing for an urban household might have been 10 or 11%. So economically underprivileged sections were to be given interest at a lower rate. Then you had a lead bank which would formulate policies for a particular district. Next, please. Regional rural banks. Again, in order to ensure that the focus is on certain backward regions which were not getting credit, these new banking institutions were started. The Grameen banks, what have become known as Grameen banks, by many of the public sector banks. So this was all the policies brought in 1969, and we will see what the kind of impact that it had on banking in India. And in the 1980s, additional measures were introduced. A very important one, most of you young people may not be aware of it, was called the Integrated Rural Development Program. It was the first time you had a credit-based asset creation program or credit-based poverty alleviation program. I'm not going to discuss that, but I wanted to just mention it. So this is the first phase of, for about almost 30 years from 1969 onwards, banking policy, which in a way was trying to include rural areas, include those who had not been included. Now, as you all know, next slide, in 1991, we had a whole set of new policies which are called economic reforms, or they're called liberalization policies. And in this realm of liberalization policies, market-based reforms, a very important change was financial liberalization. And a committee was set up under M. Narasimham, who was a member of the Reserve Bank of India governor, who said that monetary policy or the financial system is not to be interested in redistribution. That is part of government fiscal policy. And that banks should focus on profitability, on commercial modes of operation, and not on social goals or development goals. And next slide, if you will see, what happened is with this, not surprisingly, there was a reversal of many of the policies that had been introduced under social and development banking. So, for example, branch licensing policy is reversed. You don't have to open 4 branches for every urban branch. The direct lending policy, the priority sector credit, this concept began to be weakened. Now, to give you an example, I think it was in the 2000s, if a big company like, let's say, Godrej opens agricultural warehouses or storages in Mumbai, that would be called agriculture credit because it's serving agriculture. So you can see that the whole idea that priority sector should go to small farmers or should go to actual people cultivating production, this was slowly weakened. And interest rate regulations were removed. Again, a whole set of policies that were trying to reverse what had been done under social and development banking. Some new schemes were also introduced. So it's not that everything was just the reversal. And 2 things, one of them I'll talk about more than the other, is microcredit. I'll be talking more about this later, that poor households may require small loans, and one way of giving these is through forming small groups or self-help groups. like you have Kudumbashri groups in Kerala, some of you may be knowing about them. So this credit from banks to small groups without collateral, this was a new policy measure, but it remained on a very small scale, just to tell you. And then some other schemes like Kisan Credit Card was introduced. Now, these policies, as I will show, next slide, please. These policies, so what happened with the social and development banking? There was an unprecedented growth of commercial banking, unprecedented in the world. This is the words of Dr. S.L. Shetty, who worked with the Reserve Bank of India for many years, and then the EPW Foundation. The change that we saw in India in terms of the expansion of rural banking, both geographically and functionally, was unprecedented historically. That's what he wanted to say. Nowhere else in the world did we have this. In terms of increase in branches, in total credit to rural areas, credit to agriculture, credit to less banked regions. The east and northeast of India were the relatively less banked, whereas South India and Western India were relatively overbanked. So there was very dramatic change in rural India. I'll give only a few numbers later on, but I can give references, so please believe me. There was a very dramatic change in the reach of banking in rural India. But what happened after 1991? There was a very quick reversal. There was a contraction in rural banking, in priority sector lending, in preferential lending to the poor in particular. Again, there's plenty of evidence on this, which we can discuss later. So it is in this context that after 1991, after about 20 years, in the mid-2000s, the Reserve Bank of India and the Government of India and all economists realized that policies of financial liberalization had affected the rural households, particularly the rural poor. And next slide. This is the context in which the new policy of financial inclusion, officially it was announced in 2005. So almost 20 years ago now. So seeing the agrarian distress, as you know, in the 1990s, there were increasing reports of farmer suicides and so on. Seeing the failures of liberalization, there was a new emphasis laid on inclusion. And here it's very clearly stated that is to ensure access to financial services, so to credit, to deposit, to insurance, and other services to marginalized sections, low-income groups, women, etc. So again, some of those old policies were brought back, like branch expansion policy. The 25% of branches had to be in areas which are relatively unbanked. I think that's not a problem in Kerala, but in many other parts of India, particularly eastern and central India, there are large, you may be 50 kilometers and not have a bank branch. In order to make banking easier to access, the idea of banking correspondence and agents was introduced. So you didn't really need to have a bank building. You could work through agents, and multiple banking services were to be offered under this policy of financial inclusion. Next slide. Now, one very important aspect of this new policy is its emphasis on microfinance. Now, it was felt that microfinance is what is the need for the poor. And in order to expand the availability of microfinance, the Reserve Bank of India actually, from the 2005 onwards, in the last 10-15 years, has allowed new financial institutions. Small finance bank, like you might have heard of them, AU Small Finance Bank and ESAF Small Finance Bank. New small finance banks came into play. New types of what are called non-bank financial institutions hyphen microfinance institutions, NBFC, MF5. So there are some agencies, I think like in Kerala, Muthoot is very famous, but Muthuta Finance is what I'm talking about, not about the other parts. That's obviously a very big group and has many other kind of activities. So these 2 or 3 kind of new financial institutions for the first time were brought in, and their emphasis was to be on small farmers, on small business units, micro industry. So essentially, they had to lend to what is called the priority sector. Next slide. And there are other certain very important characteristics of microfinance, which was recommended by another committee which was set up by the RBI called the Maligam Committee, H. Maligam, headed by H. Maligam. So there were very clear ideas that this has to go to households with less than 5,000 rupees per annum, that a single borrower should get 25,000 or 30,000 on the first. So these are small loans. The ceiling was set on rate of interest at 24%. The kind of fees that NBFC MFI could be charged was restricted. The tenure of the loan, there were a lot of, there are a dozen kind of or more requirements that the Reserve Bank of India put on these institutions. And I'll not go into all of them. But basically, the ideas were that these would be low-cost institutions because they'll be local. They'll not be one public sector bank with a headquarter in Mumbai and operating all over India. But they'll have lower costs because they'll be more localized. They'll give small loans in installments, and that they will try not to charge too many fees to the poor borrowers. So this was the idea behind financial inclusion through microfinance. Next. So now I want to turn to, I've given you, if you like, from 1969 till today, the last, sort of 50 plus years. What have there been very clear changes in the direction of banking policy as it concerns inclusion? Now, unlike some other kinds of policy, banking policy has very clear effects and immediate effects in the statistics that we see. So I'm just going to show you a few. Let's go to the next slide. If we look over the last, as I said, from 1969-70 till 2019, which is when we have the data, every 10 years we have something called the All India Debt and Investment Surveys. And this number I've given you is showing in total outstanding debt. Okay, so outstanding debt means whatever principal I've borrowed and whatever interest I've not repaid, what is the total outstanding debt of mine? And taken in cash. So this is not loans taken as fertilizer or as a, from a grocery store, but cash loans. In 1971, only 29% of the debt of rural households came from the formal sector. So 71% came from the informal sector. This was the problem, as I said. Very rapidly, you can see by 1981, this number has become 61 all India. And if we take some states, if we take Kerala or Tamil Nadu, this number will be much higher. Kerala, of course, cooperatives are also there. In 1991, it went up a little bit. And then you see what happened after liberalization. The banking sector, because it was told it doesn't have to focus on rural areas, withdrew from rural areas, and the share of the formal sector in rural debt declined to 57 and then 56. And this is when financial inclusion policies are coming in. The microfinance, by the way, is starting in around 2014 or so. And by 2019, again, you find slowly there is again an increase in access to formal credit in the rural areas. So I think this one slide is enough to kind of, we can give more numbers and different kinds of numbers, show that there's very clear effects of banking policy, immediate effects on what happens to access to formal credit to rural households. Now, I must say here that I'm going to talk a little bit, I'm going to give an example from Tamil Nadu where I have worked recently, but this is an all India number. There's huge variation across states, and definitely Maharashtra, Kerala, Tamil Nadu, some states will be doing better than this average, and some other states will be doing much worse. Next slide. This is again the similar story with rural bank branches. You can see that from 6,000 rural bank branches in 1975, we had come to 33,000 in 1995, five-fold increase, and then again a decline in 2005. And again, now we see a small reversal. But please note that we are not back to the, sorry, we are more than the 95 number. Yeah. Next slide, please. Now, similarly, we can look at, I'm just giving you one or two examples. What is the access of scheduled caste or Dalit households to formal credit? And we can see that in 2019, which is the latest, as I said, household survey data that we have, national data from the All India Debt and Investment Survey. In 2019, 53%, this is an All India average of rural households, 53% of the debt of scheduled caste households came from the formal sector. It was 65% for other households. So scheduled castes are still worse off. If you look at it in terms of rate of interest, what section of the loans are being taken at rates of interest above 20%? It's 41% for Dalit households and 25% for other, excluding, of course, scheduled tribe households. So there's still a gap, clear gap between scheduled caste households and other households. Next slide. I wanted to give you a number about women. There's a very interesting study done by an old student of mine, Pallavi Chavan. She looked at the data from the Reserve Bank of India and found that for every 100 rupees of credit that is given to men, women receive 29. So if total credit due against outstanding to men is 100, it's 29 for women. But of every 100 rupees of deposit money, 49 is by women. So women are depositing about half what men deposit, but they're only getting a quarter in terms of access to loans. So the credit deposit ratio, what we call the credit deposit ratio, how much credit is given for every rupee deposited, this was only 27 for women, and it was 52 for men. Of course, some loans are given to companies. Not all loans are given to individuals. There's some more recent work on this. Again, I must say here, I'm not talking about this aspect, but one very important change has happened in the last decade, and that is in terms of deposit accounts, the Jan Dhan accounts and other accounts. So both men and women, very, very high proportion, have access to bank deposits. And again, you can refer to this article if you want to see it. So this deposit, that means having an account, this has improved, but how much credit can you access through that bank account? That's still very, very unequal. Next slide. Now, to give some flavor from a village that I have recently studied, and with colleagues and students, I want to just take you to a village in Tamil Nadu for the next 10-15 minutes of my talk. So this is the macro picture. We see that financial liberalization, social and development banking made a big difference in terms of the reach of formal credit in rural areas. Financial liberalization reversed much of this policy, and now financial inclusion has come. There's again some improvement, but I think the micro story will tell us what is working and what is not working in financial inclusion. But it still remains, access to credit still remains very unequal for men and women, and for households from marginalized sections, scheduled caste, scheduled tribe households, as compared to others. Now, let me take you to rural Tamil Nadu. And as I said, Tamil Nadu is one of the places where banking sector has expanded faster than the all India average. So this is a general number for all of Tamil Nadu. You can see that in 2019, 73%, that means almost 3/4 of outstanding debt of rural households in Tamil Nadu comes from the formal sector. Now, what I'm going to argue is that after going next slide, in 2019, with a group of young researchers from the Foundation for Agrarian Studies in Bangalore, we went and we conducted detailed research in 2 villages in Nagapattinam district of Tamil Nadu. And our book on this has just come out. It came out in November 23, called Economic Change in the Lower Kaveri Delta. So this was part of the old Tanjavur district and now is towards the coastal area. Next slide. So these 2 villages, I'm going to talk only about one village today because it takes some time to discuss both of them. But we chose both these villages for very specific reasons. And Palakurchi village, which I'm going to tell you a little bit about, is what is called a Slater village. In 1916, Professor Gilbert Slater, who was professor of economics in Madras University, asked all his students to, in the summer vacation, go home and study their village. And one of his students was from Palakurchi village, and he studied that village. And in fact, there's a very famous book called 6 Slater Villages. So this village has been studied in 1916, in 1938 by Gilbert Slater's students, in 1964 by an Oxford economist, in 1983 by Kathleen Duff, by the MIDS, Madras Institute of Development Studies, in 2004 by V. Sujit, a student of mine, and in 2019 we returned there. So we have actually data on a century of change in this village. And that's something, again, I can talk an hour about this village, but I'll focus only on the credit. So this is a village, we surveyed the entire village in 2019 summer, May, June, 390 households, 60% of whom are scheduled caste households. This village is very near Velangani town. Actually, that's where we stayed there. Okay, so what we found after going to this village and after collecting the data and studying what is happening to rural credit is that this number that I gave you, that Tamil Nadu has 75% of rural households have credit from the formal sector, is true, but it may be misleading. And the reason is, next slide, that, sorry, no, not this. Next slide, please. The reason is that today in rural India, maybe urban also, the formal sector is very clearly differentiated into 2 parts. And this realization came when we were working in the village. I mean, it's a fact that we know. So if you look at this, I hope this chart is visible to everybody. On the left, we have formal sources, by which we mean sources of credit regulated by the Reserve Bank of India. That is our definition of formal. And on the informal, we have our money lenders and pawn shops and friends and relatives and traders and so on. I'm not going to talk much about them. But let's come to the formal sources. There's a very clear distinction in the village we found between the public formal sector and the private. By public here, I mean scheduled commercial banks. Canara Bank was the regional, was the district lead bank in this area. The credit societies, Tamil Nadu has quite active primary agricultural credit societies. And then the private includes private banks, but I must say that this is not HDFC kind of big private bank. Those are not really operating much in rural areas. So the main private lenders, formal lenders in the village are non-bank finance companies, small finance banks, and NBFC MFIs. And we found many, many of these, L&T Finance, and I mean, there's so many of them. I don't want to go into the names. And essentially what I'm arguing today in this lecture, and this is what we've written in this book also, is that these 2 types of formal credit, the formal public sector and the formal private sector, the formal microfinance sector, not the private HDFC, as I said, but the private microfinance sector, NBFC, operate very differently on very different terms. And access to these two parts of the formal sector are very unequal by caste and class and gender and income and so on. So that is what I'm going to try and establish today for you in the next few slides. So can we just go back one slide? I'm sorry. So because my mistake, I should have put it later. So we have to help us understand, who gets access to what. We use a kind of socioeconomic class categorization in the villages based on land ownership, assets, and main source of employment. And I only want you to focus on 2 or 3 categories here. The most important section of this village, the largest section in terms of population, are what we call poor peasants. So these are households with very little land and who do not get their entire income from crop income. In fact, they get a very small part of their total income from crop cultivation. Basically, they are part of the wage labor force. And then we have the wage labor force or the proletariat. And we've got we classified them to 2 groups because there's a very large section of the village. Those who are reliant on unskilled, semi-skilled manual work. So those who are doing work in the village as agricultural labor or are working in brick kilns or working on construction sites, generally low-paid, informal sector, casual work. And then we have another section who are more skilled wage workers, because as you know, Tamil Nadu has quite a big factory sector, and many households who are residing in the villages are commuting to these factories. So these are factory workers, or they're electricians and masons. They've got some qualifications. They're more skilled workers. And these are the 3 most important sections of the village in terms of the size of the village population. And then we have at the top about 4 or 5% of the village who are the relatively rich, who we've called landlords, big capitalist farmers, and rich peasants. I'm not going to go into that categorization and how we reach there because that's another issue. But basically, we can say that they are those with larger land holdings. They have also diversified incomes, but for them, control over land and crop cultivation still remains quite important. So what I'm going to show you, next slide. Yeah, next one. Yeah. So this private, as I said, the private formal, the public formal, and the informal, we found, this is the data from the village, give very different types of loans with very different contracts, very different rates of interest, duration, everything. So for example, if you take a loan from a commercial bank and you can get it at a subsidized rate of interest, you can get a loan even at 4% or 7% per annum. If you get a loan from the cooperative society in Tamil Nadu and you pay it back within the crop year, within 9 months, it's 0. Otherwise, it's about 8 or 9%. So the range of the scheduled commercial banks and cooperatives is about 4 to 10%. The private microfinance doesn't charge anything less than 21 and goes up to 28%. But this is what they report on their websites. In reality, it's much more because these loans, for example, a typical microfinance loan, about 30,000 rupees, is you have to start repaying in installments, in EMIs, from almost the first fortnight or first month. Very often your loan of 30,000, you may only get 29. So you are actually paying interest on not on 30,000 when you actually got access only to 29. So charging interest on a reducing principal is actually leads to a very, very high rate of interest. Again, this is something we can discuss for those who are interested. And then you have your money lenders and private chit funds and traders, etc., who charge anything between 10 to 240%. So question now is, next slide, who is getting access to which type of credit? So here we have in this slide in Palakurchi in 2019, the formal public, the formal private, and the informal. So if we just take the first row, the landlords and big capitalist farmers basically only got loans from the formal sector. 89% was from the banks and cooperatives, 10% was from the other institutions, and 1% was informal. So the richer households, the landlords and rich peasants and capitalist farmers, are basically relying on the formal sector. And within the formal sector, they are relying on the public sector, which is, as I just explained, much cheaper credit than the private microfinance. Now, I should add here that the data we've used here is the principal borrowed, not the outstanding credit. Now, go to the lower end of the table. Let's take the unskilled wage workers, which is the manual workers, the last row. They got 4% of their loans from the public sector, 63% from private microfinance, and 1/3, 33%, from the informal sector. So you can see that if we look at economic or socioeconomic class categories, those who are at the bottom of the ladder, the unskilled wage workers or daily wage workers, casual wage workers, they are getting largely, they are also getting 63% of their loan is from the formal sector. So if you just looked at the official statistics, you may think, oh, this is great. Our banking system has reached the poorest, it has reached manual wage workers. Yes, it has, but I want to tell you, what way it has reached them in a few minutes. Next slide. Similarly, we can do it in other ways, and I'm just going to give one example here. So again, if you look at scheduled caste households, you can see that scheduled caste households and what are called the other castes in the village are what are OBCs, in backward classes. Both these sections of society, 60% and 40% of the village, get 76% of their loans from the formal sector. So at first glance, this looks like very equal access to formal credit. But go a little deeper and you'll see that the share of formal public and formal private is very different. 41% of loans of the scheduled castes are formal private. It's only 17% for the backward classes. So it's very different access to the two components of the formal sector. Next slide. Next slide, please. Now, I want to question that is asked is, so what is wrong with microfinance? After all, that is being regulated by the Reserve Bank of India. I'll come to that. What is it being taken for? So I told you that the microfinance loans are charged between 21 and 28% per annum. But in practice, actually, because it's to be repaid within 2 years and weekly or fortnightly or monthly installments, the actual rate of interest is higher. But let's even take what is the rate of interest on the website of these agencies, these NBFCs, MFIs. So what's wrong? Now, this table tells you what are people borrowing for. And we've taken 3 very broad categories: production, consumption, and house repair construction. Because as I think anybody in Kerala knows, investing in a house and having a proper good house is something very important for the dignity of a person, for social status. So in these villages, there's still houses which are thatch, mud and thatch houses. So borrowing, again, I'm going to look only at the lower half of this table. Let's look at skilled and formal sector wage workers, the second last row. They're borrowing only 7% for some productive enterprise. 54% is for consumption, for meeting medical expense or food expense or clothing or house something. And 39 or 40% is for house repair, house improvement. So this question here is, if the loan from microfinance is for a productive enterprise, it's very unlikely to, but it may give a return, an economic return of 10% or 15%, which will allow you to repay the loan. But how is a consumption loan or a loan for house repair going to give a return which will allow this wage worker to repay the microfinance loan? I mean, I think that is the very obvious question. Even with a productive loan, suppose 7% was taken to set up a small grocery store. The returns are not going to come within a fortnight or a month. And that's why when you take productive loans from the banking sector, you take a loan for machinery purchase or for a business, you don't have to start repaying till 6 months or 1 year, because the economic activity has to give a return before you repay. When you take a housing loan from a bank, it's a long-term loan because nobody can pay such a large sum within a year or 2 years. So this is the principles of the formal sector banking, not just in India, but worldwide, that when you give loan for economic activity, when you give loan for housing, it's not a short-term loan. It's not a loan that a person can start paying within 1 month or even less. Next slide. And so what I'm going to show here in this slide is that about 30-40% of the loans taken by the poor peasants, the wage workers, skilled and unskilled in Palakurchi village, was for housing. And where do they get these housing loans? So here I focused only on the loans taken for housing. And you can see again, if you look at the last column row, for example, the unskilled and semi-skilled manual wage workers, the poorest in this village, 73% of the loans they took for housing came from microfinance, 27% from informal. So entire loans they took for housing, for house improvement, were at very, very high rates of interest. Now, I want to say here that Tamil Nadu actually is much better than many other states in terms of housing schemes. It's had Indira Awas Yojana for many years. It has special schemes for housing for scheduled castes. So it's not that the government hasn't done anything. I'm not talking about that. But very often, as we know, the government loan comes late or comes in installments, or it's not adequate. As we know, in the construction of toilets, Swachh Bharat, the household has to put in more money on its own. So sometimes this borrowing by these poor households is to supplement what they have received from other sources. But this, what they borrow, is at very, very high cost, at very, not just very strict repayment, which is weekly, fortnightly, and where the agent, recently asked an agent this question, comes to the village weekly or fortnightly. The repayment is in cash. It's not in checks as we think maybe in the digital world, and actually harasses very often the borrower who, and sorry, I forgot to mention this very, very important point. These microfinance loans are given to women's groups. So it is the woman from this manual worker family, the woman from the Dalit family, who is the borrower and who has to somehow save face and repay the agent when he or she visits the village. Next slide. I think, yeah. So I think this is, I've come to my conclusion, really. I think this has taken a lot of time, but that, so I want to start with this, that there's still huge poverty in rural India. There's still basic needs. Not all households in this village have tapped water. Many households, as I said, still don't have cement roofs. They don't have toilets. So there's a lot of even basic infrastructure, let alone income generation, that needs to be done. And in this situation, making affordable resources, credit available to poor households is, we assumed, one of the goals of policies of financial inclusion, to ensure that those who are poor, who are marginalized sections of our society, get access to cheap credit. At least that was the vision of the earlier social and development banking. Not that it worked 100%, but it did manage to improve things a little bit in terms of reach of banking. And this was we assume, what is the policy of financial inclusion. But a very big difference in the new policies of financial inclusion of the last decade or so, unlike the earlier social and development banking, is the reliance on private financial institutions, agencies, such as these new institutions, the small finance banks, and so on, and specifically on microfinance. And I've written about this and I can talk about it more. But microfinance is small loans at very high cost. And so this is my conclusion that yes, credit through microfinance is reaching households. These institutions have expanded at a rapid rate all over India. If you see the rate of growth of some of these microfinance institutions and the profit that they're making, it's huge. So they're expanding at a very rapid rate, but the poor are paying a very high cost for accessing credit for their basic needs. And unlike the money lenders and the old informal sector, this microfinance sector is very squarely under the purview of the Reserve Bank of India. So what I would like to end with is a call to the Reserve Bank of India to review these policies of financial inclusion. Thank you very much. Sorry, can I go to the last slide? I've just thanked my student. Oh, Ritam Datta, my student, has helped me with this paper. And here are some of the references. Thank you very much.
Thank you, ma'am, for such an informative session. It gives us insight about financial inclusion, how microfinance institutions help small farmers, and the impact of different policies on rural credit. Thank you, ma'am. Now the session is open for discussion. Students as well as teachers can ask questions related to the topic.
Okay, can I initiate?
Yes, sir. Madhura, sir, please. Yeah.
Thank you. I am also as a student of Professor C.O. Abraham. Dr. Rajan Varghese spoke, I think, on behalf of all of us, he spoke. And I fully endorse whatever he has spoken on Professor C.O. Abraham. Again, I congratulate St. Bergman's College and the Department of Economics for holding such a very productive intellectual endeavor in the form of this webinar. I again congratulate the department. I thank Professor Madhura for your very inspiring talk on a very relevant, imminent topic, the rural economy of India, because India lives in our villages. So if we ignore rural, we ignore India. I don't have any contradictions or counter views on your thesis. I fully agree with that. However, for some discussion, I want to bring 3 points. First, you referred to the 2 phases of financial inclusion. From the very inception of India's first 5-year plan, professors like Dr. K.N. Raj, they were very particular that India should follow a policy of inclusion. And we had that very productive step in 1969, as you correctly observed. But what was the socio-economic policy context of India at that time? We had the planning. It was not market economy, it was a planned economy. And when we came to this sort of a new era, where we know that for the 11th, 12th, 5-year plan, the preamble spoke about inclusion. Because we recognized that the neoliberal policies were exclusive. But again, my query is whether we have this sort of ornamental policies could retrieve the type of social achievement we had earlier. Because the philosophy has changed. Market is playing its game. And not only that, some of the international studies, like the Inequality Lab of Paris School of Economics, and many others like that, they all confirm that the new attempt is not that productive. So this is my first response on inclusion, which you spoke. The second point, that is, okay, the second point is on the type of rural-urban migration. We had the bitter experience of this sort of a migration in the late COVID-19. So what may be the policy which we have to think about in India, where the vast masses of people are living in villages, and they are now, because they cannot live in the villages. That is why they want to go to the urban areas. But we had the bitter lesson. So from a policy point of view, how, again, there is another dimension. We find some sort of north-south migration. So what may be your observation on this sort of rural-urban migration as well as north-south migration? That is my second point. And the third point, you may respond or you may ignore. That is on farmer distress and agitations of today. Your own father proposed a formula for minimum support price. Why the government is hesitant to implement that? And that is the very argument of the farmer organizations. Why can't the government implement it? What prevents the government from implementing it? So if you want to respond that too, again, we also want to remember your father also in this context. So these are the three humble points of mine. And I personally appreciate the presentation. Congratulations. Thank you very much. Okay.
Thank you. Should I respond now, Renee, or?
Yes, ma'am. You can.
Thank you very much, Dr. Mathikurian. I don't think I can take up all your questions, but I agree with your comments that we have moved from the era, the philosophy, not just of economics, but of development policy, and so this is a little part and parcel of that. Just to give you an example from the area that I was talking about, when the microfinance NBFC MFI Maligam committee first made its recommendations around 2013-14, they had said there should be a ceiling on the rate of interest charged by MFIs. But about a year ago, the RBI removed the ceiling. So even with the ceiling, it was high, but now the RBI removed the ceiling, saying there should be competition in the market. So the whole thinking is different, and I think at the same time it's important to work on it because we still see so much rural poverty and distress. Now that links me to your second point, actually, that in these villages of Tamil Nadu, and as I about 1/3 we calculated of the income of the poor, the wage worker households, the manual households, the rural labor households, is coming from outside the village, either by workers who commute or through remittances. So this link with the urban economy is very, very close. And in Tamil Nadu, as you know, the very good network of roads and bus transport and all that. So, but I think in a longer term, if we think about this, so there is no doubt that there's inadequate employment opportunities, inadequate income from agriculture that relates to your MSP point. Maybe I'll come to that in the end. And so rural workers are seeking employment. But many of them are still only single men. They're not going with their whole family because we have not made urban conditions, urban housing, etc., as easily available. So people who, for example, even in Bangalore, is in north-south, we have from all over Assam, and men who are coming as taxi drivers or security or as domestic staff. They are living in such precarious condition that they cannot bring their family. So they send. So I think we have to really think about expansion of urban facilities for uh, the worker households, construction workers, and others. As we saw during COVID, they didn't have a place to sleep; they had to leave. So for that reason, the urban economy is very closely tied to the rural. And I think this is something we will find probably in North India. 50% of the income is coming from remittance. From in these two villages of Tamil Nadu, about 30% of the income is from remittance. So that's going to be increasingly important. But we don't see still a shift out of the village, because I think the urban conditions are not suitable enough yet. Urban infrastructure is not ready. I'll come back to farmer distress, because a different issue at the end of the talk at this time. I hope you don't mind that. Yeah, that is. And I think Dr. Cyril Philip has given two questions. I don't know if you'd like to state them, or shall I take the questions from the chat box, or?
Yes, you can. Cyril, would you like to ask the question yourself?
Uh, no, I think the
Yeah,
questions
okay.
are
Yeah,
there.
so one is about the payment apps. Yes, this GPay and all is there in little shops and other things. But very interestingly, this was not in Tamil Nadu, but just last summer in UP, we asked one of these microfinance agents, but all this is supposed to be digital. You're not supposed to give cash transactions. So they said, yes, we give the microfinance loan into the account of these women, but when we take the repayment, we take it by cash, and then we do the GPay into our account. So the extraction of funds from the rural poor is still through cash. And the housing scheme, in fact, one of my colleagues who has written in this book I mentioned is an edited book with many authors. There is one chapter which focuses on housing by Dr. Gopinath from Chennai, and he has looked at what are the housing schemes of government of Tamil Nadu, how much money do they give, and how much additional expenditure is being spent by poor households in order to make improvements. And this is the additional amounts is largely what house repair or house improvement, additional improvements is what the rural households are borrowing for. There's another question in the chat box about land records. Land record digitization, in fact, is again being studied by some of my younger colleagues after we went to this village. It's not complete, but in this village and neighboring villages which we studied, village of Vinmani, those who are members of the cooperative society, whether your land record is digitized or not, you are assured of very cheap credit through the agricultural cooperative society. So I think here the digitization is not important. It is who are the members of the cooperative. And if you have been accepted as a member of the cooperative, then you get access to, as far as credit is concerned. But we are trying to use the digitization data. My young colleagues are trying to use it to see pattern of ownership of land holding. And in Palakurchi village, there is an NGO, a Gandhian NGO, which bought land from some of the landlords and tried to redistribute the land, at a price. And when they redistributed, it was not redistributed, when they distributed at a cost to landless households land, it was usually in the name of women. So one of the things we're trying to do with the digitization is to see if we can see the pattern of land ownership by women. But I don't think, as far as the lending is concerned, especially because, as I showed, the poor households, even the poor peasants who have small amounts of land, the wage workers are really landless. They're largely borrowing 60-70% of their borrowing is from the private sector, which is microfinance or loans without collateral. So there is no need to show land records. Land record is for your Kisan credit card or for your standard crop loans, which you take from banks. And in fact, even now banks give these gold loans. They're called agriculture gold loans. They're so-called for agriculture, but basically they're against gold as collateral. So land as collateral and for which recording of land becomes very important, is largely through the cooperative society in Tamil Nadu. And there, as long as the cooperative knows you're a landowner, it doesn't matter any land record is digitized or not. At least that's our understanding so far.
Good evening, ma'am.
Yes, good evening.
And thank you for a wonderful session for us. My name is Adityan. I'm a student of St. Berkman's College. So, in this session, we have analyzed the data of Palakurchi village, which we have seen that the access of wage workers or poor persons to the public sector credit institution is very low. And beyond that, there is some fact that to get a credit from a public sector bank, there is many procedures which might be long and complex. So my question is whether the inability of access of wage workers, poor persons to the public sector credit institution is because of these long and complex procedures.
Okay, so that used to be called, that is called transactions costs in the literature. And originally this was the argument that was given. But I think now, one very important point which I mentioned very briefly is almost all these households have bank accounts because they may be getting some benefit through the government pension scheme or something else, offer NREGA wage payments, and they have KYC for their bank accounts. So a little bit of the procedures that were there earlier, I think have become less onerous because these are the people who are going to borrow already have a bank account, and already the bank has their PAN card and so many other things and knows all their name and address and everything else. So one having to prove yourself as a genuine person, I think that has gone down. At the same time, of course, it's true that the agent of the microfinance comes to the village, whereas when it's a bank, you have to go to the bank. And this is another reason why the Reserve Bank started these business correspondent and that kind of model. The idea was banking at the doorstep. So I think with digital technology, with the fact that there's so much information that banks already have in their KYC, they know so much about us now, that this should have become easier. So I think we can't say that that is the main reason now for lack of access. It is because the kind of banks credit that is being given by banks is largely against collateral. So that is land or it is gold. And if you don't have land and gold, then the government of India, through its new policy, is not saying let banks lend to groups, that small self-help groups, as I mentioned, which was a policy earlier, but it's saying, let banks not bother with this, let microfinance do that. So you have to lend with limited collateral when you lend to the poor, and that's a fact of banking. But I think that in terms of the procedures, if anything, it's easier now for bankers to get information about the individuals who are coming to borrow. So that remains an issue, but I think the ease of just getting money while you're sitting in your home and the agent comes is different. But I think that is something which is a problem which is more easily resolvable now by the formal banking sector.
Okay, thank you, ma'am.
A very good question. Yeah.
Good evening, ma'am.
Hello.
Ma'am, my question is, what is the major challenge or limitation that microfinance institutions face or have in our country when it comes to promoting financial inclusion? Are there any inbuilt shortfalls in the system of microcredits that can hinder its working for what it was actually implemented for?
I don't know whether you call it a shortfall or not. Microfinance is entirely driven by profit making. Now, I have written another paper, I didn't mention it today, but the microfinance and small finance banks, at the rate at which they are growing, expanding, the rate of return, there's a concept called rate of return on assets, ROA, return on investment, that you have in the banking sector. If it is 1 for public sector banks, it's 3. For every rupee lent, they make 3 times the profit, because they get money from the banks, and public sector banks now are supposed to give a certain amount of their priority sector credit to microfinance. They get it from public sector banks at say 9 or 10% per annum, or say even 11%, and they lend it out at 28. So even if their costs are 5, 6, 7%, because they say we have to have many agents who will go to the bank, who will do this, who will do that, they are making huge profits. So I think it's just a very simple that these are entirely profit-making institutions. They are not there to lend for housing. You've had, Housing Development Finance Corporation. You have so many housing companies, not just in India, but in other parts of the world, where to give loans for improved housing, you always give long-term loans. That mortgages which are mentioned in the US market, you'll hear about it. They're 20-year mortgages. Nobody repays a housing loan in the week after they get the loan. So I think this is a whole entirely, if you ask me, it's the logic of microfinance. So if you don't agree with the logic, which I don't, that's the problem. It's not a so to expect microfinance to give long-term housing loan is a wrong assumption, given the way the microfinance model works, which is short-term profits. And the fact that the Reserve Bank of India or the government of India is not able to realize that the poor are borrowing for housing, for which they need credit on different terms. They need lower interest and a longer time period for repayment. So, which is the world over, which is when I take a housing loan, one of you will take a housing loan one day. That is how it works. So you can't expect a person to start paying a housing loan at the end of the month in which the loan is taken. So I think this is a wrong premise on the basis of the Reserve Bank of India, if you ask me. And microfinance is entirely driven by profit. And one new component of this, which I have not talked about today, but which is very important, is these microfinance companies are getting money from foreign investors. So actually it is global money, finance, which is coming now into this very big expanding sector, because you're getting a rate of return of 10 to 15%. There's no place you can invest in UK and get 10-15% per annum. So I think this is global finance is being used to lend to the poor in India. And the Indian poor are actually making the profits for these investors. So I think the whole model is built like this, and it's the logic of the model. So it's not, we have to say that this is not a suitable model for rural India. We can't try and change parts of it.
Good evening, ma'am.
Hello.
Since we have had all this discussion and and about the lecture you delivered, how can we actually strengthen with the current state they are in? How can we actually strengthen and improve? Like, what are the kind of measures that we can introduce to strengthen our current financial institutions, even in the public or even in the private ones?
Oh gosh, that's a big question. But I think one thing is that, say, for example, earlier we had cooperatives. And again, I think some of you may know more, because Kerala has a very strong cooperative sector. Maharashtra has a cooperative sector. So you can have different forms of lending where you can give households access to credit at better terms. That's one. Second is, I think the basic question is not financial or banking policy. Why are the poor borrowing for housing? That means our housing scheme is giving inadequate finance. They're giving 1 lakh or 2 lakh, which may not be enough to build a house. Definitely in Kerala, nobody will build a house for that amount. So the public sector schemes, the public policy, whether is not providing some of the things. So if we say, the banking sector may say, look here, I can't lend to poor people for housing, they'll never repay it. Fair enough. So we can't put this burden on the banking sector. Then it's the role of the government to either give adequate funding or to build houses for the poor. And neither are houses being built, nor is adequate funding being given for these houses. And so these poor households get a little bit of money from the government and then borrow at very high rates of interest. So I think some of the issues I've raised are to do with public policy, not necessarily in the sphere of banking, but in other spheres. Just to give you an example, in the sphere of housing. Same thing, you will have seen Swachh Bharat, you will have seen pictures of toilets in so many villages in India, particularly in North India, where it's half constructed, there's no water. So we've not done it completely. For a poor household, half construction and half your own cost doesn't work. Or make the water connection yourself doesn't work. So I think some of this is a failure of development policy in general, not just banking policy, because not everything can be done by banks. But at the same time, there are forms of public sector banking or cooperative banking which could provide more reasonable credit. And you had so very specifically, you had the women's self-help group lending from public sector banks. Like now, I believe Kudumbashree groups get money from public sector banks and then give it to their members. Now, that kind of lending in India is on a very, very micro scale. That could be expanded rather than lend it through the microfinance. But the policy shift has come and the emphasis has gone to microfinance in this. So I think these are complex issues. I don't think there's one answer, and I'm not really able to, competent to give all the answers on this. So I'll stop with that. And I'll just say to Dr. Kurian that maybe the farmer protest is a very big question. So I won't have enough time to answer it today. But I think, again, it is I think the philosophy which you mentioned, that it is markets which have to provide, and it is not the role of the government to ensure minimum prices or adequate incomes for farmers. I think that is the driving ideology of this. And unfortunately, I mean, what I always say in my lectures is in the EU, in the European Union, they spend 63 billion euros a year on farm subsidies. US spends huge amounts on farm subsidy. So agriculture is something which is essential for our food and nutrition. And world over, whether it's US, whether it's Europe, whether it's Japan, it's heavily, heavily subsidized because we have to ensure that farmers can live a decent life. We want them to grow food for us. And this is something that is, it's not unique to India, but unfortunately, it is the kind of economic philosophy that is prevalent, I think, that is preventing this government from taking up these issues at a real serious level and ensuring, whether it is MSP or whether it's some other way, ensuring a decent income for farm households. Thank you.
Thank you, ma'am. So finally, to propose a word of thanks, I invite Johnson P. Joyce, our program coordinator and faculty of Department of Economics.
Honorable Professor Madhura Swaminathan, Dr. Rajan Varghese, other esteemed guests, faculty members, my dear colleagues, and my dear students. It is my privilege to propose a vote of thanks on this occasion. On behalf of the Department of Economics and all the participants, I would like to express our deepest gratitude to Professor Madhura Swaminathan for her enlightening lecture on rural credit and financial inclusion in India. Her insights into the inclusivity of India's banking policy, particularly in relation to the marginalized sections of the society, have been truly thought-provoking. Her analysis, based on the data from rural India, has raised important questions about the reach and effectiveness of our policies. This has not only enriched our understanding, but also highlighted areas where further work is needed. On behalf of the Department of Economics, St. Berkman's College, Changanasheri, and all the participants who have gathered here, I extend our sincere gratitude to dear ma'am. Thank you, ma'am. I would also like to express our sincere gratitude to Dr. Rajan Varghese, Organizing Secretary of Kerala State Higher Education Council, and our beloved alumnus, for his touching remembrance of Professor C. Abraham, whose legacy continues to inspire us in our pursuit of knowledge and service. His immediate acceptance of our invitation reflects his affection and warmth towards this department, and also regarding his teachers. On behalf of the department, I extend our great heartfelt thanks to Dr. Rajan Varghese. Thank you, sir. Thank you very much. Our heartfelt thanks to our principal, Raji P. Kurian, for Reverend Father Raji P. Kurian, for presiding over this event and for the unwavering support for academic excellence and intellectual discourse. Your leadership has been instrumental in shaping the academic environment of our institution. Thank you, Father. I would also like to thank Dr. Shinuvarki for your valuable insights and for being part of this memorable event and leading this event. Your presence has enriched our discussion and added depth to our understanding the topics in hand. Thank you, sir. Thank you very much. Finally, I extend my gratitude to all the audience of all the former teachers and my dear students and all the students from other colleges who has participated in this event. Thank you very much. Thank you, ma'am.